this is where we kind of get into kind of more of the specifics here, okay? And again, I know it's early in the morning, and again, I don't want to put you back to sleep with this, but this matters, okay? This part here. And what this slide is, you see it's the S&P 500 operating earnings per share. Okay, so think about the S&P 500 basically as a company, single company, okay? And you aggregate the earnings of all the 500 companies up to it, and you get an earnings per share for the market, okay? And ultimately, so this is tracking it. This is quarterly data, but ultimately, I could overlay the S&P 500, the market on there, and it's going to look basically just like this, okay? The market is going to follow this line, and this is corporate profit growth. So the interesting part of it is where we are now at the very end. There's basically two major companies that track this data. One is actually S&P. That's the blue line. The red is Thomson Reuters, sometimes known as First Call. Okay, you'll hear these names and kind of sometimes in the press from there. But what you see is that they follow each other very closely, except for kind of where we are now. Thomson Reuters is basically saying corporate profit growth has flattened. It'll actually for this year will be basically about down 1%. S&P is showing a much more significant decline. Okay, from there. They're actually, in their current estimates, we're going through fourth quarter earnings now, they're looking at about an 8% decline year over year in earnings. Okay, and just real quick, if you're wondering, okay, well, what's the difference between the two? S&P basically tracks GAAP earnings. Okay, so when companies report and they may have certain charges or kind of extraordinary items or one-off items and from there, S&P includes most of those on an operating basis. Thomson Reuters basically says, look, we're going to look through those, and they exclude it, okay? And so the big difference there, this probably won't come to a huge shock to you, but that where are most of those items and charges coming from is in the energy sector, okay? So S&P is basically saying, look, we're including those, Thomson's not. So look, you can kind of take your pick, okay? But I don't think, it's not happen chance that the S&P last year was basically flat, okay? And that red line for Thomson Reuters is basically flat, okay, from there. But really what matters, though, is what do those lines do going forward, okay? Expectations are that the lines resume an uptrend. Matter of fact, our number is 119, so that's roughly about a 5% earnings growth rate for this year. S&P is currently at 121, so they're looking for a pretty significant rebound from there. The problem is a month ago that number was 124. A year ago it was 135. Okay, so those expectations have come down. But in either case, the course or the trajectory of those lines going forward is ultimately going to determine the trajectory of the market. Okay, if they go up, we should see the market follow it. If they go down, the market's going to follow it. Okay, from that standpoint. So let's talk about what are some of the things that are driving that. Okay, why are we now at basically flat earnings on the U.S.? Okay, there's two primary earnings headwinds, if you will, right now. One, everybody in the room, I'm sure you've noticed, certainly if you've been to the gas station lately. But one is the fall in commodity prices, and specifically oil. Okay, and that matters it matters from an earnings standpoint. Okay, and to put it in perspective, a year and a half ago, when we were still at roughly $100 oil, if you looked at world global oil producers, okay, the companies, they were at an annualized revenue rate of 3.8 trillion. Today, it's 1.4. Okay, that's a big drop. Okay, and so that from an earnings standpoint. Okay, from there. So how does this get resolved, if you will, and at what point do commodity prices stabilize? As I said, it came into this morning, crude oil, WTI, Brent, whichever one you want to use, we're roughly at about $30. Okay, on that. So the price of anything really is determined at the margin. Okay, by the marginal producer and by the marginal supplier. So let's look at the production side. The blue line here is U.S. Total production. We peaked last June at roughly 9.6 million barrels of crude oil a day. Okay, and from there we have another data point that shows 9.3. Today we're roughly at we're roughly at 9 million. So production is coming down slowly. That red line is the U.S. oil rig count from Baker Hughes. Okay, so we have gone from, what is that, roughly 1,600 rigs to that shows you to just under 500. On Friday, we had a decline. We're now down to, I think, roughly 461 oil rigs producing, okay, in the U.S. So the question is what does that blue line do? And how does that go forward? Because look, what I meant, the reason why we're at 30 is because we have a supply-demand imbalance in crude oil. Right now, we are currently producing about 1.5 million barrels on a global basis, 1.5 million barrels a day more than we need, okay? And so that imbalance is what is causing a very, very sharp drop in the commodity price, or in this case, the price of crude oil. So how that blue line comes down, to what extent, and then projections, if what our estimates is that we'll go below 450 rigs over time over the next 6 to 12 months, that should take U.S. production down to about 8.5 million barrels a day, okay? So that's a million coming out of that 1.5 oversupply. Now, the other part of that, okay, well now let's talk about demand, okay? And again, demand, so where's marginal demand coming from? I'm using here, the blue line is China, real GDP, their growth, and then obviously the red line is the price of crude oil. And as you can see, those two go hand in hand. And so when we talk about, okay, well, what is growth in China doing from there? If you look at it over the first, in the 2000s, okay, and people refer to the great commodity super cycle. Remember, all commodity prices, whether it was copper, steel, crude oil, all were going straight up. Okay, we'll look at China's growth rate. Okay, it peaked out 07 at roughly almost 15% real GDP. Okay, now where has it done since? Last reading, now they're at 6.9%. Okay, that's the official number. The real number is probably somewhere south of that. Okay, so but in either case, we need to see this part of it, and China's kind of a proxy really for all developing markets because they are the ones who are the incremental new demand. It's not in the U.S. and Europe. We're not the ones who are now going to. We may drive a little bit more, but look, our economies, we're actually shifting much more over to natural gas and other fuel types as opposed to using more crude oil. Okay, from there. So how that growth rate there plays out matters. Now, just to kind of get off to an aside here. China is, global demand right now, the estimate is that it'll basically increase about 500,000 barrels a day, okay, per day. That'll be the growth rate. That should get you back into basically equilibrium, okay? And that is expected again by about the end of the year. Okay, here's where things get complicated, okay, to the extent if you're interested in this. Okay, we have a kind of a, I don't know, grudge match going on, basically specifically with OPEC, but Saudi Arabia. Okay, you remember I talked about U.S. we hit 9.6 million barrels per day. It was at that level that U.S. production was going to surpass Saudi Arabia. Okay, and remember, the prices are determined at the margin. The U.S. was at that point was going to become the marginal producer, okay, of crude oil, and especially if you include Canada, we were over 13 million barrels a day. Okay, so that was going to matter. Saudis did not want to give that position up, okay? And they also could see where it was going. Okay, so they have said, look, instead of them, typically, historically, they would say we get oversupply, the Saudis would cut back production, the market gets imbalanced. They said no more. We're not playing that game anymore, okay? We're not giving up market share. You want to get back in balance, you cut, okay? Or we're going to take it out of these high-cost producing areas, U.S. shale, Canadian oil sands, et cetera. Okay, so anyhow, so here we are today. We're still looking at this oversupply, and what was interesting was last week, Saudi Arabia came out and said, any increase in global demand that shows up, we are going to meet with an increase in production, okay? And that matters to the markets because what they are saying is that either you're going to have to continue to cut more on the production side or we're going to maintain this oversupply position, i.e. we're going to keep prices low for longer. And that's what you're seeing in the market and in certain areas, certainly the energy areas, which have been extremely hard hit, is because that rationale, that realization is setting in, okay? The markets and analysts were very, very slow. They're like, yeah, we're at 40. Okay, we're at 40, but we're going back to 60, okay? And now they're saying, well, we're at 30. We may go to 20, and we may stay in this area for, longer than we expect. And that matters, again, from an earnings standpoint, okay? So this is why, but in either case, from an aggregate earnings standpoint, we need to see how that commodity price plays out matters from there.